So let's get going. I just heard something else that's really nasty, but we'll see if I can find it. Okay, access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders are discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockworld.com, PSW, nor its affiliates, or any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker dealers. Nothing in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless. Many losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. Yay! Okay. So, how exciting is this market? Up 300, down 300. Whoops. Oh, I need that. Where'd it go? I lost it. What'd I do? Son of a bitch. Did I just delete that? Apparently I did. All right. So much for that. Anyway, so it's we'll use this chart instead. We'll use these charts instead. There we go. Okay. So where are we today? Look at that. Boom. So if we zoom out to the dailies, as you can see, we're really only about halfway recovered. The Russell still has to get a little higher before it even gets to its strong bounce line. A strong bounce, by the way, in other words, a bounce, what we call a bounce, a weak bounce is 20% of the drop corrected, and a strong bounce will be obviously 40%. Therefore, if you're down from 1600 to 1460, that's 140 points. That means you're going to have 28-point bounces, call it 30-point bounces, to 1490 and 1520. So 1520 would be your strong bounce line on the Russell. All right, now I rounded off whatever. It's not, by the way, it's a very important thing about the 5% rule. It is not science. I made it up. Okay, just like every other friggin' TA, anything you ever saw, somebody made it up and put a label on it. And once enough people, like Elliott Wave, some guy named Elliott did it. Okay, and it's called the Elliott Wave because a guy named Elliott made it up. All right, it's not science. I didn't discover it. It's not Pythagorean's theorem. It's not an absolute in nature that I uncovered and proved. That's I think part of the problem is people get confused about the difference between something that's a scientific fact and something that's a widely held belief. The 5% rule is based on my observation of how computer trading programs behave. So that's what they tend to do. They tend to fall, they retrace. There's certain predictable patterns that you'll see when computers trade a market, and computers are getting close to 90% of all trading is now done by computers. We are like, we're like Casey Jones at this point. Was it Casey Jones? I don't know. Whoever the guy was who, the guy who had the contest against the machine to dig a mine or something, his heart exploded. I don't know. I don't think that was Casey Jones. Casey Jones was the Grateful Dead song. Anyway, there was this guy, and I'm sure you guys know the story. I can't think of what it was. Somebody will probably tell me. But anyway, we're the last ones. We're the last humans working here, and it's very sad. But on the other hand, though, computers are predictable. This is why This is why for many, many years, they had computers playing chess. And computers were great at calculating, but they weren't great at playing chess. And most chess masters could kick their ass. That's why it's a huge thing when IBM finally had a computer that could beat the chess champions. It was a huge leap in computers because the problem with computers, and it's not so much the computer's fault. I mean, there's a certain lack of processing power, but there's also a lack of programming ability, a lack of imagination and ability on the part of the programmers to write the programs that are good enough to compete with people who are mentally more flexible. You know, in other words, you know, I'll tell you so. The first time I invested in Crocs was when it was a startup, and the reason I invested in Crocs is because I read the New York Times every weekend, cover to cover, and I mean cover to cover. Like I read every single word in the paper, basically. And the reason I do that is that it's a habit I've had essentially my whole life. My father used to do it too, so I guess I got it from him. But the reason I do it is because you never know what thing you read is going to remind you of something or help you later. It forces you to read things that you ordinarily wouldn't. Like I could care less about fashion. I could care less about you know, home and garden, things like that. But I still read those sections because, you know, you never know when you're going to get an idea or something comes up. And also I like to read different people's opinions and see what's going on. You know, and again, I'm not politicizing the New York Times. It's just, it was for 100 and something years and still is today, in my opinion, the paper of record. I mean, it's the paper that you go to read what's actually happening. You know, if you want the actual facts of a story, that's usually where you can find it. But anyway, so I read this article about kids in Africa that were cutting up tires and taking string and tying the shoes to the tires to their feet to make sneakers. And it was very, very popular in Africa. A ridiculously non-important piece of information. But then when Crocs came along, a lot of people were like, well, that's the stupidest thing I ever heard of. And I'm thinking right away, I'm like, well, that's that thing people do in Africa. They put a piece of rubber on the bottom of their foot and they're happy as clams. They think that's a great shoe. So that led me to invest in Crocs, just knowing that there's an entire, you know, continent full of people who think that that's a great idea already. It wasn't some off the wall fashion thing. It was a actual useful thing, and that's what ended up happening with Crocs. It was a fad for a while, but now it's like the go-to thing for waiters and doctors and anybody who has to stand on their feet all day. That's like the go-to thing. You know, they passed their prime and whatever, but when we made the investment, it was a huge winner. Anyway, so you never know what it is you're going to read that turns out to be important. Anyway, so where was it? I was talking about live traders. So that's the difference between live traders and robots. That's what I was going to say. The difference between a live trader and a robot is that a live trader, a person like me, person like you, a live trader will go home at night and watch Deal or No Deal, and they will contemplate the way people make choices. And a live person will listen to a political speech, and you know the expression, you know which way the wind is blowing. You know, you start to see a change in the environment, and it's not going to be in the data. It's not going to be obvious, but you'll start to see it. A live person like me is going to listen to their children and see that something is becoming a trend, or that, you know, that Snapchat is the thing now. No, you know, Twitter became, you know, Twitter lost out to Snapchat essentially, and kids could care less about Twitter. It doesn't show up in the numbers because my kids don't cancel their Twitter accounts. That's the thing you got to realize. You know, my kids don't cancel the Twitter accounts. Twitter account doesn't cost me anything to have it. So Twitter doesn't show a decline in users. After a while, they show a decline in active users, but people still tweet and it just fades out. So you don't know that the active users are less active or anything like that. It takes a long time for these things to show up in the numbers. And that's where you can beat robots. That's where these robots, they trade based on a headline report. They also don't yet, and again, they will down the road, they'll learn, and sadly, people like me, because I used to consult on the original trading programs, and it'll be people like me who end up getting a big fat check from Goldman Sachs, and I'll go in there and I'll tell them, you know, what, not me particularly, because I don't like Goldman Sachs, but you know, somebody will go in and tell them what they're doing wrong and what they need to listen to. You know, and eventually they'll figure out how to program that into the computer, so the computer does start paying attention to the less obvious stuff, and it does start paying attention to, as I teach the members here, you can't just say an analyst said this, therefore. It's who is the analyst? What did he say? What does he usually say? Does he have any idea what he's talking about? What are the, you know, you can't just take any single piece of information. You know, like every day, these stocks react to somebody upgrades, somebody downgrades, and it moves this much. And it's all an algorithm, though. It's not because people are coming in. People don't react that quickly. People aren't getting out of bed at 8 in the morning to trade a stock because an analyst upgraded it. That's not what's happening. It's the computers. As soon as the trading opens up, there are algorithms that kick in because something was said, and the AI that read it said, "Oh, okay, that analyst says up there for 0.25% up. You know, will accumulate 0.25% more stock." You know, it could be an idiotic statement. I mean, look at today, Tesla, which is amazing. They had their roofs caught their solar panels caught fire on Walmart's roof 7 times. You would think that would kill Tesla. I mean, this is that whole solar city that they way overpaid for anyway, and their number one client that was touted as a huge example of why you should be using Solar City. I don't know if you guys saw that story, but I got to show you. It's real important. Tesla, Walmart. Walmart is now suing Tesla. They've had, look, 7 times. This is, you know, I don't know how they know it before it becomes a big deal. 7 times solar panels on their roof have burst into flames. Now, imagine this starts happening in people's homes. It's been 7 stores. It's only 7 stores in 7 years. So once a year, this happens. And they put panels on 240 stores. Now, 7 out of 240 is not a small number. I don't know what that number is, but it's probably about 3. 7 divided by 240. Yeah, 3. That's very good, Phil. See, I'm proud of myself. Always gets another brain still working. You know, this is not an unserious thing when solar panels catch fire. Now, we don't know the story yet. It could be older panels, blah, 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 blah. But anyway, so Tesla stock goes down 2.6% today, which is a decent amount. I mean, 2.6% is nothing to sneeze at, but I would have thought it would have gotten hit a little bit harder than that, because that's what I would call a pretty big deal. So the biggest problem for them is that they're in a lawsuit. And why are they in a lawsuit? That's what I don't understand either. Also, why? Well, we'll have to read more on it. But I mean, what's going on here? What's Walmart want to do? They're filing a multi-million-dollar lawsuit. They say Tesla's negligent installation and maintenance of solar panels caused the fires. And then, you know, look, Walmart's got better things to do than sue Tesla for some money. So they must be really pissed off, and it must be something that Tesla's not fixing. And this is just going to give them constant bad news. And Tesla allowing it to get this far is crazy. They should be bending over backwards to fix it and sweeping it under the rug. Now it's all public, and it's all going to come out. If they actually go to a trial, it's all going to come out. It's crazy. Walmart asked Tesla to deactivate all of its solar panels pending an investigation. Even after this was done, they had another fire. Wow. And Tesla's own inspection revealed 157 action items or replacement of system components, 48 of which Tesla characterized as reflecting conditions that rendered the sites unsafe or potentially unsafe. Wow. And then Walmart says they found out even more stuff than Tesla did. They engaged in widespread systemic negligence and failed to abide by the prudent industry practices in installing, operating, and maintaining solar systems. So, you know, look, this is a problem. It's probably a general problem in the industry. You got to be careful. You know, you can't just let the cheapest guy do your solar contracting, because if they screw it up, your house could catch fire. That's crazy, though. I mean, how they let the thing is, it's so incompetent of Tesla to allow it to go this far. I understand it's a big contract, obviously, 240. You know, it could be $240 million, but meanwhile, it's only 10% of Tesla's losses anyway. They could have swept it under the rug. They could have done something and fixed it or helped or something. That it should have been handled, obviously, way better than it has been. And that just goes back to a statement on Musk and how poorly he manages and how poor his managers are. A lot of these people have left. And you know, clearly, I mean, you can see that these are pretty cheaply done panels. I mean, see, these bars are very thin and the panels themselves are very thin. Now, I'm not saying they should be thicker, they're probably what they should be, but the panels are thin, the bars are thin, there's not a support anywhere, there's certainly nothing cooling them. And when you're on a roof in a commercial property, you have more heat because it's flat and large and asphalty. These things and these roofs are not meant to have something on top of them trapping heat. But anyway, so there's ways you have to design it and put it in. You can't just slap the panels along the roof. You have to have cooling systems and runoffs and things that that's what they're saying. Standard industry practices are not being followed, and that's kind of ridiculous. So we will see what happens in that. But you know, it's so things like that anyway. This is why I read everything, because you need to know these things. If you're gonna be a serious investor, you need to know everything that's going on, not just some of the things that are going on. And that's the weakness computers have. They only know some of the things that are going on, and we are able to take advantage of that. John Henry, thanks, Dan. Okay. Oh, that's right. I made it. Dan says, don't forget the spitting cobra. That's another pattern we made up. That one actually caught on. People started using it. Anyway, spitting cobra pattern is this basically, which is very accurate. I discovered. This is my description of it. In other words, when you see the stock start to rise, make these coils like a cobra does when it kind of rises itself, and then it gets up here. I say it's a spinning cobra pattern, which means that basically it's ready to strike. And when it strikes, what's a cobra do when it strikes? It strikes downward, not up. And that's where you can see these patterns emerging. So that's what I call a spinning cobra pattern, is that when you see the stock get up and up and up like this, and it's coiled on itself, and it looks like it's kind of topping out at this spot, then you're waiting for it to like go boom, forward and down. And it's just a matter of running out of energy. But you see that pattern a lot, and that's what I call the spinning cobra. But the 5% rule, like I said, which we made up, we didn't make it up. I made up the 5% rule the same way that Elliott Wave made up Elliott Waves. It's a rule that I use based on what I observe to be the computer's behavior. So when you have a retrace, you usually will get a bounce. So when you get first of all, but the problem with the 5% rule is it's not a purely mathematical thing. You have to actually use your brains, and this is what turns a lot of people off because people don't like using their brains. But you have to use your brains. You have to find consolidation points and figure out where the value actually occurred. But of course, this is why the 5% rule kicks the crap out of every other TA that's out there, because we're actually using some fundamental analysis, not just treating every number like it's totally valid. So in other words, we don't pay attention to this spike down to 1586. It only lasted for like, this is a weekly chart, it only lasted for less than a week. And then you're back to 17, and really this whole thing only lasted less than a month, and you're back to 18. So realistically, you know, this pattern comes in around 20. You know, maybe you might want to call it maybe a little less, probably like 20. 20 is a round number. So basically, you know, Macy's has a base at 20 and went up to 40, got rudely rejected at 40 though, and has since come back, failed 20, but once it failed 20, it had no support whatsoever, came all the way back down to its lows. All right, and this looks super ugly right now, but if 2 weeks from now we're back over 18, this will be the same kind of spike that you ignore that you have now. And, you know, Macy's is getting killed based on all the retailers getting killed. If you look at the this thing over here, you see how these patterns go? They tend to go the down pattern when the black thing goes through down here. It tends to sort of start one of these, and those can last for quite a while, and that's how you get this big downtrend. Well, unfortunately, they just did it again, and they're downtrending again. So this might go on for a while, unless, of course, it reverses super quickly, like this. You see how this, well, this never made it down, but this was gonna go down, and then all of a sudden it reversed and stopped the thing flat, and it went back up. It could still happen here. But if you start forming a couple of more of these, and these are weekly, so in other words, 2 weeks from now, if you start seeing more black lines below the surf, below the top, that's going to be ugly. And I would be very, very worried about where Macy's is actually going. I think Macy's is super underpriced though. Oh, and in fact, yesterday, for the hemp Boca portfolio, we added Tenet Health. And we'll look at that in a minute. We have 5 stocks. We're picking 5 stocks, and so far we've done 2 officially. This will be our 3rd. We've got 5 stocks that are going to make $5,000 each by January. So if you want to make $25,000 between now and Christmas, so that you can impress your family, this is going to be the way we want to do it. So we'll look at the chart here. Actually, we should go back to Macy's first. I was going to make a point about the 5%. So if you're down from 40 to 20, or if you're up from 40 to 20, let's see if the 5% rule works here. So 40 to 20 is a 20-point run, right? That means your retraces are going to be 4, 20% of the 20-point run. So your retrace is going to be 4, and a stronger retrace will be 8. Also, your bounces will be 4 and 8. So that means every 4 points is going to be significant. So let's see if it is. So we have 40, obviously rejected. 36, that's this line right here. Okay, not that significant. Is the, oh wait, 36, sorry. It's this line, sorry. So it's this line right here. It obviously formed basically the top. And if you look, half is below and half is above 36. So that's about right. It was definitely a top over here. That would lead then to a sell-off to 34. Where's 34? No, I'm sorry, 32. 32 would be the next level. So, oh, this blue line is 32. Okay, so 32 would be the next significant point. And it should be also significant on the way up. So you should see 24, and you look at 24, and look at 24 on the way down. Interesting, right? There's 24, here's 24 on the way down. So you got a consolidation over there, and then you go up to 28. This line, consolidate. Oh, look at all these points on 28. See that point, that point, that point, that point, that point. See all those points on 28? So clearly 28 was very significant on the way up. And then the next stop would be 32, and you see how 32 is the next stop, and then 36, and then 40. So every 4 on Macy's is where you have a significant amount. So you're going to go down from 40 to 36 to 32, and then to 28, which is here where it failed, right? And see what happens when it fails 28? Big drop. That would take you to 24 if the 5% rule is correct, and here's 24. See that? And then the next stop would be 20, and below 20 is the same problem. You failed, you have no support, so you're doomed. So it blew right past 20, but down to 16. And now 16 is where we're probably going to hold, because 16 is what you call an overshoot. So the same way that you have a bounce, you also can have an overshoot, and you very, very rarely get a strong overshoot. A weak overshoot, though, is extremely common, and that would be, in this case, 4 points below the line that you expect it to hold. So at 16, we're now overshooting. And that basically means it's a panic. That's when you have a panic and people are dumping and so on and so forth. But at the overshoot spot, that's usually where the people, where new people come in to buy who are going to be long-term holders. The real fundamental investors start stepping in and picking up the stock. So we'll see if that happens. But meanwhile, Macy is very, very much following the 5% rule. And it's something that you could easily predict very far in advance. Then we talked about Tenet. Tenet Healthcare, again, it's a little tricky here. Maybe 16 would be something I'd call a consolidation line on Tenet. I'd have to look at a longer term list if we can find Yahoo. And yes, value comes into play as well. And I would say, oops, about Tenet, THC. All right, so you might want to look at the 5-year. Well, that's weird. Oh, it's just the scale of this chart is kind of weird. That is 14. Okay, just didn't look like it. So, you really got a bottom here along the 14 something 15 line. So 15 really is where you've got some serious support. And where did you top out? You topped out about 60. I don't know what happens if we can move this. No, we can't move that. Oh, shoot. Oh, here you can move it. Oh, yeah, look at that big top out at 60. Okay. So basically, you're going to be looking at a range on Tenet. And by the way, we don't buy it because of the 5% rule. The 5% rule is just a way that once we decide we like it, we then use that to figure out where good entries and exits are. So 60 to 20 was the drop on Tenet over the long haul. And below that, 60 to 20 is 40 points. That means you're going to have an 8-point overshoot on a 40-point drop. 20% of 40 is 8. And what's 20 minus 8? 12. Do we have a 12? Can we confirm that? Yes, we can. That's your overshoot. Okay, now if it's really an overshoot, you should, in pretty short order, and pretty short order doesn't mean tomorrow, pretty short order is 1 quarter. When you're looking at a monthly chart or weekly chart, then you have to think in terms of months, not days. But getting back to 20, you should get back to 20 in short order, and then 20 should hold. So in other words, this was an overshoot, and then it gets back to 20 where it should be, and then it consolidates around 20. That's what I think it's doing. I think it's consolidating around 20. Now, what's 20? More importantly, what is 20 on Tenet Healthcare? And it's a $2 billion company at 20. It's basically 1 billion shares. So at 20, it's a $2 billion company. And last year, they made $111 million. Okay, but this year, they should do much better. So they're going to make, what's 186? 240 is, 60, about 30% more. So they'll make about they'll make about $140 million this year. So that puts their PE down in the range of about 7. And next year, even more. Okay, so they've done some mergers and acquisition stuff and various things. They own a huge amount of hospitals basically, and everybody's uncertain about healthcare and what's going to happen and the regulations and so on and so forth. But this is a top hospital chain that has 18 billion, 19 billion, 19 billion, 18 billion. Their revenues are pretty flat. And it's really just a question of managing internally their stuff, but also they got to pay down their debt on the balance sheet. So they generate a lot of cash, but they also have a decent amount of debt, $14 billion, because it's effectively a real estate play. And people forget to look at things like that. You know, you've got, they've got, I want to say 300 hospitals, something like that. Company, 68 hospitals, 475 outpatient centers, as well as, wow, okay, they're much more than I thought. So 475 plus 255, 725 plus miscellaneous 8. They have like 800 different clinics and hospitals around the country, and 90,000 employees. And a lot of them, I mean, obviously some they rent, but so a lot of them are hospitals where they own land and so on and so forth. So it's like having, you know, a lot of companies that run a break-even business, if they own their properties, it's just like if you rent a house. If you're a landlord and you rent a house and you're breaking even on the occupancy, and you're paying it off, because what's your business? Everybody say, well, you're a terrible businessman, you're not making a profit. But 30 years later, when you pay off your mortgage and you own all these properties free and clear, you're suddenly a freaking genius, right? That's patient money. That's the way you make patient money in real estate. You use the business to pay off your mortgage. And people forget that that's part of these businesses. Even more so, the way the tax laws are now structured, they're constantly depreciating everything they have. So it makes all their stuff look like it's worth less and less and less as time goes by. So you're like, well, what are they paying off? They got nothing. You know, a lot of the telco companies like that too. You're like, well, they have no assets. They're pointless. They got no assets and they owe billions of dollars. Like, they don't have no assets. They just wrote all their assets off. They gave them no value. When they go to sell them, they'll have to declare capital gains, but that's fine for the way they structure their business. And they'll figure out how to make more losses before that anyway. But people forget to look at these things that way. So there's nothing wrong. And by the way, when I say people, not everybody, because there's plenty of long-term, you know, real investors who do look at it that way. They don't look at just the balance sheet. But again, problems with robots, right? Robots don't necessarily take this into account. They're just looking at a straight out balance sheet. They don't think of the intangibles of a business. You know, IBM, for example, spends a fortune on R&D, right? That's very intangible. They take a lot of the money that they make and spend it on R&D. IBM is granted more patents than any other company in the world. IBM patents per year. I don't know if it'll show any other companies. Images, I bet there'll be something here that will show us. Here you go. This is typical for IBM. Top patent winners 2017. IBM 9,000. Second is Samsung 5,000. Below that, look how fast it drops. 3,000. 2,500. Microsoft, Google, blah blah blah. IBM 9,000 patents. IBM breaks patent record in 25th straight year as #1. Okay, so when you buy IBM, you're buying the future. Okay, it's nice that they make money now, but they've got 9,000 new patents this year on stuff that that down the road could become much more valuable. You know, the problem is though, when you're buying IBM, they're going to put more money into patents next year. They're going to put more money into R&D next year. That's how they do their business. If you like that kind of business, great. But it makes it very difficult, though, to take it and compare it to other companies. How do you compare IBM to Dell? Dell has no patents. They don't patent anything. They'll use it stuff that other people patent, and they buy it from them and put it together. There's nothing wrong with that model. But they're not out there doing the research. And then people, well, IBM doesn't have the computer part anymore. They sold it to Lenovo. But basically, if people look at IBM as a computer company. Who are their peers? Dell, HP is a peer of IBM, and HP is more of a peer than Dell is. What's that? The patent owners. I don't know what that means. Players dead and alive patents. I don't know what that means. And there's blockchain. Top patent holders by type of renewable energy. That's interesting. Oh, fuel cell energy. Who's got a lot of patents? GM. See, sleepy little GM. We know Toyota is a big innovator. You don't think of GM as being such a big innovator. Here's our old friend GE with the wind patents, and LG is big on the solar patents. SunPower, my favorite guys, big on the solar patents. IBM sneaking in there. So you buy a company for a lot of reasons, and it's very difficult for a computer to grasp all the reasons that a company is valuable. And that's how a lot of things sometimes get sold off to ridiculous extents. The REITs that are selling off now are some crazy low numbers for the REITs. They've just gone out of favor. There's the concept that the low rates is especially the mortgage REITs, because the mortgage REITs make money on the rate spread. If the rate's super low, you can't make money on the rate spread. There's less of it. They'll still make money though. It's not like they won't make money. They'll make some money. And as long as you can get through the part where you make some money, you'll get back to a part where you make a lot of money down the road. But investors are not patient. Investors are trained to look very, very quarter to quarter. And so are the trading bots and the algorithms, because they need to see results. Okay, if you think about it, somebody's basically saying to this trading robot, an algorithm, and saying, if you don't perform well this quarter, you might get erased and replaced with another program. They're under the same pressure that a human is, except for them, it's complete oblivion, because instead of firing a programmer, if you fire your trader because he doesn't perform well, he goes and gets another job somewhere else. If you fire your trading bot, it's your trading bot that you wrote the program for, and most likely you're going to erase it from existence. You're going to murder it just because it didn't do well, and you'll just replace it with another one, and then you'll threaten that one's life for the next quarter. And it's funny because there's people talking about robot rights now, because if you're going to start creating these artificial intelligences, you can't treat them like crap. But it's getting a little silly, but it's very funny when you think about it, because you're creating a consciousness. That's our goal. Our goal is to create something that's fairly conscious, and eventually we're going to get it. And then at that point, though, you can't treat it like it's but just some lines of code anymore. You made something you're responsible for. So that's going to be weird also. But anyway, until we get there, though, the bottom line is computers are much dumber than people, and they will not be able. They can be taught to do specific things, but trading is not a specific task. Chess is although there are billions and billions of possible moves, those moves are all very structured. There's only a certain amount of things that can happen in chess. In other words, the rook in a chess game is not going to go on TV and smoke pot like Elon Musk did. That's just not going to happen in chess. It's going to do one of several things in the next few moves. It cannot do more than a certain amount of things in the next couple of moves, because it's limited by what it can do. So that's why computers can understand chess. Chess is a program. And that goes for other games. Games have rules. Although in theory, finance has rules, those rules are often broken. They're broken by a tremendous advance, a tremendous change. Climate change is screwing up all sorts of things that you used to take for granted, and will forevermore now. So eventually they'll be able to model climate change in. But for now, like it cracks me up. People are still paying millions of dollars for waterfront homes in Miami. They literally 25 years from now will be in the water. There's pretty much no way that the sea level in Miami and anywhere, but really Miami because they're at sea level. There's pretty much no way in Miami that a apartment that touches the floor is not going to have 3 feet of water in it in 25 years. We're certainly going to have that much of a rise in tides. People are worried it's going to be a lot worse than that. In 50 years, definitely like 5 to 10 feet. 100 years from now, they're saying, you know, it could be like 20 feet of water. 20 feet is 2 stories of a home. And that's pretty much Florida's gone. And there, you know, you can see that climate change Miami. Like this. That's what Miami's going to look like. And, you know, you know, I guess, I mean, you can say I don't believe in that stuff, but it's real. It's like, it's all the math checks. Not only does math check out, but every time like they're doing deeper and deeper studies and they're finding it's worse than they think all the time. You know, but Florida is basically a swamp. I mean, you can't dig more than 6 feet down. We have shallow graves for the people who live here. When you die, they put you in a less than 6 foot down grave because once you hit 6 feet, you hit water. Almost all of Florida is just barely 6 feet above water, and it's a very, very flat state. And you know, any rise in sea level is going to be devastating for like huge areas along the coast. You know, and the coast is there's only what does it take? It's an hour and a half, so it's about 90 miles across to the other side of the state, and you can lose you know a good mile or 2 of land on each side. You know, it could, and again, that's just giving it a fairly limited model where you're only talking about 10 to 20 feet rise in sea levels. But when you start talking about, you know, what you know, like Greenland, by the way. Oh, what was the number for Greenland? Greenland ice melt. 7% 7% of Greenland has melted since 1950. By 2050, 40% will have melted away. There you go, 40%. Wikipedia needs money, by the way. Please give Wikipedia money, everybody. I can only give so much. Okay? It's like, for God's sake, if it wasn't for Wikipedia, we wouldn't know what the hell was going on. All right. Change an ice sheet. I don't know. Anyways, they're like right now in Greenland, which Trump is trying to buy, I guess to hide the global warming. Okay. Lost 12 billion tons in a day, blah, blah, blah. Okay, there you go. Just Greenland, forget the Arctic and everything else. Just Greenland has enough ice to raise the sea level of the entire planet by 20 feet. That's not good. Whoops. 23 feet, blah, blah, blah. Anyway, so, you know, this is happening. It's a real thing. So meanwhile, again, so why would I buy a place in Miami on the water that has a 30-year mortgage? And by the way, you say, oh, well, I'm not going to stay there for 30 years. You're not going to stay there for 30 years, but 5 years from now, it might become extremely apparent to people, instead of the denial that we have now in government, you'll have you might get a president in 5 years that says, okay, this is real, it's a huge emergency, which frankly the rest of the world already did in Paris, we just ignored it. But if we start saying this is an emergency, here's what's going to happen, and blah, 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 people are going to start leaving these places, and they're not going to, you won't find another sucker to pay the kind of money you paid for that apartment or for that house, whatever it is. You've got to think ahead. You've got to think outside the box. You can't just compare it on Zillow to other homes in that area. You have to look at the bigger picture about what you're doing. If you're buying that home and you say, I can make my money back by renting it for 15 years at such and such a price, but then what's your end game? Your end game would be that you're going to then have the home free and clear and you can sell it, right? But what if the sales price is far, far below what you thought it was going to be? What if nobody wants to buy waterfront property in Miami 15 years from now by the time you pay it off? Then your zero that you're making every year to pay off, you're watching the property, maintaining the property, you're making zero, maybe you're putting some in for taxes and so on and so forth. And 15 years from now, when you thought you were going to pay off the property and sell it, nobody's willing to pay the $1 million you paid, so you only get $500,000, $400,000. So could you have done something better with the money over the course of 15 years than put it into this home and gotten a crappy return? And you have to think of these things now. You can't think of these things 15 years from now. And that's true of any investment you make. You've got to think about what are you getting into this investment for? What's your time frame? What else could you be doing with the money? So on and so forth. These are really important things you need to know. Where was I? Okay, so balances, we were talking about all kinds of stuff. I forgot where it was. Okay, futures. So balances, right. So that's how we calculate how far we expect things to drop. So when you go from 8,000 to 7,400, see again, you throw out spikes. That's what I mean by it's not a law, it's a rule. It's a rule, which I said you've got to take the consolidation points, because and again, that's the problem with TA. TA doesn't do this. You have to look for the consolidation points. Clearly, we consolidated around 8,000. Clearly, this was a spike and you should ignore it. Therefore, 8,000 to 7,400 is 600. All right, so let's move the NASDAQ a little closer. So 8,000, wherever that, oh, sorry, we're over here. So 8,000 to 7,400, and again, this is a spike we're ignoring, and these are days. So it's hard to ignore one, below, above, below, way below, way below, way below. We're like 2 weeks worth of action. It's very hard to ignore that when you're in it. When you're in the middle of it, it seems like it's really important. That's why you have to learn to think in the longer term and think about, like, I call it zooming out. Like in my mind, I'm always zooming out and looking at the bigger picture. So I don't just look, when I'm doing these things, I don't just look at the daily or the hourly or whatever. I look at the longer terms and see if my trends are really holding up over time. So what do we say? So 8,000 to 7,400 is 600 points. That means your bounces are going to be 20% of 600 is 120. So therefore, you're going to look for 75.20 would be a bounce, which is right over here, which not very conclusive. And then the next one will be 76.40. And that's going to be in the middle over here. Also, yeah, not that conclusive, but you can see where it's like, okay, we are moving up at 76.40. We're consolidating again, back below, back above. Notice how it's even though. This is a midpoint. That's what a consolidation is. It's a bit, it goes above, it goes below, it goes back below, stays down this long, goes back above this long. That doesn't change anything. You're still here at 76.40. You're still consolidating in the bigger picture on the 76.40 line. And where's the 76.40 line? Right, see that? Right along there, basically. So half above, half below. That's what consolidation is. All right. So, and then if you look at it, on a weekly, it's just a little bit over here. It looks drastic when you look in the hourly. You're like, wow, look at that, things all over the place. But you back it out and you start when you go monthly, and oh, we stayed there for the month. It barely moved. That's what the month actually looks like. It has a huge tail and a top, but in the end, it basically stayed at the top of the range. So far, we haven't done anything that really indicates a big drop. But unfortunately, this is what happens when you get to the top, is you get to the top, you have one of these stay at the top of the range, and then all of a sudden people actually come in and start selling like crazy. You know, and you can see it here too. See these funny things? Whenever you see these kind of things that spike up and spike down like that, that just shows a lot of uncertainty. And you have to be very careful about once you see a trend go below it, you got some big problems. But then we have to take into account that, you know, Trump is pulling out all the stops to keep the market going. In a few minutes, we're going to get the Fed report that's going to tell us how much the Fed seems to be on board with pushing the narrative for the market. You know, Trump's got an obvious motivation. He doesn't want a bad economy going into the election. So if this market crashes going into the election next year, we have 1 year basically, it's going to hurt his chances for re-election. So he thinks that by forcing the Fed to lower rates and by talking about more tax cuts and so on and so forth, that he can push the recession back until after the election so that he can still go around claiming things are great. Now, that reminds me, speaking of Trump claiming things are great, this blew my mind today. And not that I don't tell you that it happens, but to actually see how drastic it is shocking. So, you know, I tell you that this administration particularly, and all administrations fudge the data a little bit and are willing to, push a number here, push a number here. And like I say about especially unemployment, you react to the good numbers, but then they go and correct it with a more accurate reading, and then nobody cares about the more accurate number being different. Now, usually it's 50,000, 100,000, something like that. It's no drastic things, and it's not, and sometimes it's up and sometimes it's down. What we've noticed as a pattern in Trump is that consistently the jobs number that they publish is higher almost every single time than what they'll correct it for a couple of months later. So now they've just done a full audit of 2018. And it turns out that Trump's administration exaggerated the jobs number by 500,000 jobs. That's every month, 40,000 jobs, which is 20% of all jobs created. Well, actually, since there were way less jobs created, it's more like 30%. Because in reality, it's only, I'd say 180,000 jobs were actually created on a monthly basis than Trump claimed. That's the fact of the matter, that every single month they lie to you by 40,000 jobs. And and by the way, that's above all the corrections, because there have been many, many interim corrections that, so in other words, the initial report says 250,000 jobs, and then a month later they revised it down to 200,000 jobs. Turns out the 200,000 jobs wasn't real either. And now that they've done a full edit, it turns out that hiring did not only didn't hiring get a boost, it's anemic. Because we add, the population adds, what's that number? US population growth by year, 0.7%, which is out of 325 million people. So that's about 2.1, 2.2 million, whatever, 2 point something million people. So in other words, the population grows by a couple of million people a year. Therefore, 180,000 jobs a month is only keeping the population, is only keeping it steady, not growth. So there are less jobs created, unemployment's higher than you think, so on and so forth. Now, on the bright side, this gives the Fed more ammunition to say, well, we still need to lower rates then because we don't have as many jobs as we thought. But the funny thing is, though, the market, part of the reason we have this massive bullish market is because we're swallowing all these freaking lies on a regular basis. They're making up numbers, and it's not just jobs. They get to fudge the GDP numbers. We talked about this last week, I think. We were talking about something, and I pointed out, what was it? Oh, it's GEG's health cost. I don't know if it was during the webinar, but very, very tiny little changes in your assumptions can lead to very big changes in the numbers you end up reporting. And GDP is like that too. All they have to do is make a little rule change that says round this up instead of don't round this up. And the little 0.5% here and 0.5% there can make a huge difference. So it doesn't take too many rule changes to pump up numbers any way you want them to. Now, eventually there's going to be an audit. Like the CBO just audited our economy and said, no, your GDP is 1.8%. It's not 2 point anything percent. It's 1.8% is the GDP growth now. Again, anemic. Why is it anemic? Because there's 500,000 less jobs than anybody thought there were. 500,000 more people are out of work than you thought. There are 500,000 less people working than you thought. Therefore, obviously, many, many numbers that you are assuming are wrong. And it's really terrifying that we're living with a government that's willing to do this. It's freaking exactly what we used to accuse the Soviet Union of doing, 30 years ago, 40 years ago, is what we're doing. We have Pravda. It's called Fox News. It's a state-run news, or it's a state-sponsored, or whatever you want to call it. It works with the state news organization that publishes bullshit. We have a polling agency called Rasmussen that works for the president that has zero credibility among the political people and so on and so forth. People who actually care about polling and are consumers of polling data, Rasmussen's a joke. But unfortunately, it's the joke that's the official polling of Fox News, and it's the only one Trump will quote because it's the only one he's winning in. It's not the same. They're not all the same. You don't just trust anybody who conducts a survey. The way you ask a question has an intense effect on the answer. Should are you pro-choice or pro-life? Just something like that is a very loaded sort of thing. Okay. When should babies be killed in the womb? Okay, should babies be killed at 3 months or 6 months or 9 months in the womb? When you put a question to somebody like that, it's still the question is, when do you abort? You just called a baby killing. But it doesn't say that. The poll comes out and says, 75% of people think it's bad to kill babies. They think abortion should be banned. But all they said is they're like, baby killing. No, I don't want to kill babies. That doesn't sound good. Nobody's going to say yes to baby killing. But if you ask the question that way, you'll get a very different polling result. And then they do that. And that's why you get these telephone surveys and all these things. It's all very shady as far as like who's conducting it and who they're doing it for and who's paying the bills and so on and so forth. And obviously it used to be that we would trust the New York Times, we would trust MSNBC, we would trust the Washington Post, that they had a certain degree of credibility. And what's happened in the last 10 years is the tactic that Fox News had. And there's this great documentary on like Netflix or HBO about Roger Ailes, at his time at Fox News and what he did. But what they did is instead they couldn't make themselves more credible, so they effectively made everybody else less credible, so that they made it seem like nobody can be trusted and it's all fake news, right? Because what was happening 5 years ago or so is people were calling Fox fake news, and it was sticking because people knew. You could tell it was fake news. It was obviously fake. They were getting caught. They were getting caught faking crowd sizes. They were getting caught faking outcomes to things. They were getting caught like saying one thing and doing another. They were getting caught paying people to come on the show and say stuff that wasn't true. People were starting to catch them in all their lies. So they had a big credibility problem. So they solved their credibility problem not by becoming more credible, because it's not an option. They're a propaganda network. They're not a news station. So they couldn't make themselves more credible and still do their job. So instead, they made everybody else less credible. And they started having Trump, people like that, start this fake news thing that accuse everybody of being fake news, as if all news is fake, as if the whole media doesn't matter. And now people can't tell. Here's our Fed minutes now. And by the way, all this matters for trading. Obviously, it matters if you've got an administration that's lying about 500,000 jobs. Obviously, that matters somehow. We're trying to make decisions. Oh, that's a statement. We don't want the statement. Minutes. There we go. So let's see what the Fed has to say. Oh my God, look at all these people. Oh, I forget how big this thing is. What's the summary? Trade uncertainty is likely to persist, according to the Fed. The Fed rate cut is viewed as recalibration. Trade policy uncertainty is elevated. Did we just say that? I want to see that. Economic situation. Okay, we'll click on that. I don't know if this is particularly good. I think it's a sort of neutral statement. The information available in the meeting, all right, labor market conditions remain strong. See, this is going to change. In light of this new data, that's going to change. The real GDP increased at a moderate rate, and again, no, it did not. We just did an audit, and it's slowing. Now, these are reasons the Fed is going to consider cutting. Consumer price inflation was below 2% in June, but in July it creeped up. Survey measures based on longer run. So there's a little bit of a balance there. So in other words, there's less people working than they thought, which means it's easier to lower rates. But on the other hand, prices are moving up. And even with 500,000 less jobs created, we still have a pretty low unemployment figure. So I don't think this on the whole changes the Fed much, but it does give them an excuse to raise. I'm sorry, to lower. So I think that might happen. But I don't think a half a point, I think a quarter point. Non-farm payroll expanded solid rate on average, supported by brisk gains in June. The unemployment rate edged up to 3.7% in June, was historically low. The labor force sees a lot of the stuff is about jobs, and they're not getting real data. That's what's crazy. This whole section here is about employment. Then they move on to consumer prices. Those have gone up. We're probably 1.6% now, which isn't terrible, but it's getting close to where their goal is. The average monthly change in PCE. All right, real consumer expenditures grows briskly in the quarter, supported by a robust pace of light motor vehicles. Real PCE rose slowly. Key factors. Low unemployment rate, yes, and again, back to the employment. See, so many things depend on this one data point that when that changes, you have to start thinking about what else is that going to change then? How is their thinking going to change? Knowing that GDP is weaker than they thought and that unemployment is higher than they thought, and therefore it pushes them more likely to cut. So on the whole, it's going to be supportive of the market prices. We're not going to probably see a big dip off of this report here. Some of the members of the Fed argued that there should be a bigger than 0.25% cut, but a couple objected to the cut at all. And so it's a question of figuring out where the balance is going to shift and who's going to win that argument. But again, so if people were arguing for no cut, they went to 0.25, despite the arguments of people who said no cut. Now there's data supporting the cut. Is very, very, very likely that they're going to cut another 0.25 at the next meeting next month. Now, how much of that is already priced into the market? How much of our rally is already based on the fact that we expect this to happen? Dan says, look at the fertility rate is less than 2. Yeah, we're not even replacing. Most of the civilized countries of the first world countries are at this point where we're below the replacement rate in population. But that's good, actually. I mean, there's too many people in the world, and we need to have less people. So it's good if we just have less babies and we gradually, very slowly, get back to like 6 billion would be nice. We can't just keep adding people. They say that we're going to top out at 10 billion. But to me, 10 billion is too many. I mean, 8 billion is too many, probably. It's not a crowding issue. There's still plenty of places to put people, but the strain that we're putting on the global environment is what you have to consider. On the whole, and this is where what's his face was right. The bad guy in the Avengers, Thanos. Is that his name, Thanos? Anyway. So he wanted to eliminate half of the galaxy's population due to overcrowding, and basically that's about right. I mean, if we had 4 billion people on the planet, it would be a lot healthier. We wouldn't be hurting it as badly as we are. But the way we live, we either need to reduce our usage of resources, or we need to reduce how many people there are. But we can't have it both ways. You can't have 10 billion people using resources at the rate that we're using them. That's terrifying. And again, it goes back to the global warming. We already may have destroyed the planet. It may be too late anyway. It's not going to get any better. And by the way, that's part of the reason I think people aren't having more children. I mean, I don't want to get depressing, but I mean, I look at my kids and I think about that, and I'm like, I don't know what the world's going to be like when they're my age. I don't have it's possible that we can get over the hump and fix some stuff, but we got some really big problems that we're not addressing. And if we don't do something about it, I could see where my kids are going to be thinking really hard in 20 years about whether they don't have 20 years actually. Both my kids are in college, so 10 years from now or sooner, they'll be deciding whether to have kids or not of their own. And I'd be a lot less eager to have children than I was when I was their age, because I'm very worried about what's going to happen. It's going to be a hard life. You're not going to have all the stuff you're used to anymore. You're going to have limited amounts of fresh water, limited amounts of clean environment. Basically, you're going to have to worry about where you're breathing your air. And the way we've rolled back regulations now, it can spiral out of control. Not to mention the global warming issue, where could be. I mean, look, it was like 105 degrees yesterday in Florida. When I went outside, I was like, holy crap. That's not normal in Florida. It does happen in August. I mean, it's not avoidable, but that's only 105. We have, if we start getting a few degrees of global warming, we could have 110, 115 degrees days. And they have those in Saudi Arabia, but they don't have them in the freaking humid environment. That's like horrible for you. So I think that's one of the reasons fertility rate goes down, is I think a lot of people in developed countries start wondering about whether or not they really want to have children at all, whether you want to bring more children into this with all the uncertainty about the future. Uh-oh, Trump is talking about challenging China on trade again? Seriously? Well, Byrne says, will you be reviewing the hedge strategy in new hedges? Yes, we will be looking at that. So given all the uncertainty, let's talk about that also. Okay, so the indexes. I'm sorry, let's get back to one. Let's finish one topic, then move on. Wait. John says, as an aside from finances, I have sleepless nights about the state of the planet and climate. This could be a hellscape for subsequent generations, barren seas and score. Okay, that's not helping. It doesn't make me happy. Yeah. I mean, look. It's always something. like in the 70s, we used to still in my school, we used to still do the atomic drills, you know, like the siren drills, where you would like get under your desk. They do the siren thing, and you would get under your desk. I was in New York, and I always thought it was comical as a kid because unlike I think pretty much most, I was always into like science and stuff. So like most kids in my class, they think you're going to be saved from an atomic bomb blast by getting under your desk, and I'm sitting there like, this is really stupid. It's like, I mean, yeah, you shouldn't look at where the flash is. That's helpful in case it's far away. You can still go blind. Radiation. Nobody's handing out radiation suits. You know, and so if your building is close enough to a nuclear blast that debris is flying around, you've got much bigger problems than the debris. You're probably going to get radiation, cancer, and stuff like that. So that was the 70s. Later in the 70s, we were all worried about the environment and everything else. Then in the 80s, we stopped worrying about anything. Then in the 90s, we started worrying about like Wall Street and the economy and greed and all that crap. And then in 2000, you were right. Then it became terrorism. Then we started worrying about terrorism. There's always something that's going to end the world or make the world a terrible place and blah blah blah. I think that's just human nature. I think you're always worried about something ending everything. But the global warming thing is a fact. It's warming up. We aren't made to survive in warmer temperatures than we know this, okay? You know that if you go to the middle of the desert and you walk around for a couple of hours, you will die, without water. Global warming is going to make large places on this planet that we're used to inhabiting uninhabitable. And it's going to force the populations to squeeze into inhabitable places. And there's the immigration crisis. So, of course, global warming forces people out of their homes. They have to emigrate out to other countries. There's no other place for them to go. They can't live where they're living anymore. And there'll be millions and millions of refugees from climate change as well. And that's going to cause problems. And then there'll be food shortages and blah, blah. I mean, so this is all happening. And it doesn't matter whether it's man-made or not man-made, it's happening. And it does lead to a tougher life. But a lot of these problems, we overcome a lot of stuff. Maybe they'll invent better air conditioners. Maybe we'll all move underground and live in caves or something. I don't know. And I don't mean like caves, like horrible caves. I mean, maybe it'll be like the cool thing to do. So like everybody will have underground cities. Like Atlanta. Atlanta's got a whole little underground city section. And it's lovely. It's a big tourist attraction. So I don't think it's good to overly worry about stuff, but on the other hand, it's just, you can't turn a blind eye either. It's like somebody's got to do something. And that I find is the weirdest thing about the global warming is everybody talks about, the argument from the conservatives is like, oh, well, it's probably not man-made, it's natural. It's like, okay, if it's natural, if there's a flood coming to your house and it's natural or man-made, what's the freaking difference? You still need to do something about it, okay? You still need to put sandbags up, you still need to insulate, you still need to cover things and make sure water doesn't get in and so on and so forth. It's like you don't do nothing because it's not man-made. That's asinine. We need to do something. And I don't understand how people fall for this sort of line of reasoning that instead of talking about what we need to do, we're talking about whether or not it's man-made or not. Who cares? That doesn't matter. Warmer is warmer. Rising tides are rising tides. It doesn't matter why they're rising. We need to do something, whatever we can. And one of the things we can do is reduce our carbon output, which will slow the process. Might not be our fault, but we certainly contribute. We could also spend trillions of dollars doing research to figure out how to take the carbon out of the air. Okay, we could to some extent regulate the Earth's climate by taking carbon out of the air, and when we need more carbon, we'll put carbon back in the air. We can regulate the entire atmosphere. So wouldn't that be nice if we could really do it at will? How would you do that? You'd have to put carbon capture units all around the planet, in a massive globally coordinated effort where internationally there'd have to be a body that agrees on where the how much carbon should be taken out this month, how much carbon is allowed to be put back in, so on and so forth. Somebody's got to balance the whole thing on a global scale. All the countries have to work together. That's what the Paris Climate Accord was all about, was moving the ball forward on that extent. Everybody, of course, has to contribute funds to that effort to make it work. And maybe we could fix it, but we're not even trying. And that's sick. Okay, that's like literally, that is like, you see a flood coming, you have adequate warning a flood is coming, there's 100 things you could do about it to protect your home, but you choose not to because you want to see who you should blame about the flood. You say, oh no, that's somebody's fault, that flood, or it's not somebody's fault, that flood, it's just a natural thing. So what? Save your home, protect your family. That's what the conversation should be, and this whole bullshit about whose fault global warming is a complete distraction from doing something about it. I don't understand how that's a question, but it's not really that. It's a distraction, and the people who want to keep polluting are basically thrilled that we can be so easily distracted by that. That instead of actually talking about the problem and fixing it and doing something about it, we're sitting here talking about whether or not it's man-made or not. It's sad. It really is very sad that that's where we are. Anyway, what was I going to talk about? Something very important. Oh yeah, hedges and stuff. So this rally is fantastic for our portfolios. The long-term portfolio is, let's see where we're at. Should have a nice bump today. 172%. I don't even know what that number reflects. Wow. So back to 1363. On Friday, when we did the review, hang on a second, home. That's crazy. So on Friday, we did our long-term portfolio review. What's going on? Huh. 1277. So it's up. We're up 140,000. Is that right? 1363 versus 1227. So 136. Yeah, so about $140,000 since Friday. So that's kind of crazy. And we haven't, the adjustments aren't in yet, so we're probably up more because we did a lot of bullish adjustments on Friday. We rolled those to lowers. We did a lot of rolling to push ourselves into better positions, looking for the bounces. We added to ETM. NRZ just had good news today, so that's good. What did I say about GE? Oh, that was just a comment. We don't have GE. Thinking about it. We added to ALB. They're popping. Everything's popping, of course. I mean, it's just the way things are going. Citibank came back a bit. As the Best Buy, we rolled the puts. BHC, we bought back the short calls because they were so low. Citibank, we bought back the short calls. So no, we got more aggressive by pulling back short calls and rolling long calls down to lower strikes. So we did a lot of that. So we're probably up close to $200,000 at this point from Friday. Now the short-term portfolio is probably down, but I don't think that badly. And so the key is, if the long-term portfolio can gain and lose a couple of $100,000 in a few days, yeah, So we were like we were about $800,000 in the short-term portfolio. Now we're at 775. So that's great. The short-term portfolio only lost $25,000, while the long-term portfolio gained $200,000. That's great because we didn't really push our hedges. But now we have to say, well, that $200,000, boom, like that. We can lose it very, very quickly. So we have to now think that we should probably be spending more money to protect in the short-term portfolio, to do a better job of hedging and to do a better job of locking in our gains. So it's going to cost us money, but you have to say that the it's 1 point, what we said is 1.36 plus almost 8 here is we're about $2.2 million basically in the portfolios. We topped out at 2.3, so we're not quite as good as we were. But of course, the market is still lower than it was, so that's why. The market's lower. Not, we didn't, and again, that's because we didn't fully lock in what we had. So we have to decide now in the short-term portfolio, how much more are we willing to spend on hedges to lock in the gains? The big hedges we have now are, that's not a big hedge. We have this TLT. Let's not even count the TLT. We've got DXD, where we have, we did make a change in the short-term portfolio. Hang on a second. What day did we review that? No, it wasn't Friday. Was it Thursday? Okay, we added 200 January 30, 35-45 bull call spreads. Did I say what it was? Was it SQQ? I guess it was SQQ. All right, we'll figure that out in a second. It was SQQ. Okay. So in the what we changed on Thursday for the short-term portfolio is we added 200 January 35-45 bull call spreads. These are 2021s. These are the 48 calls that are short. So they're going to expire worthless. See, that's the thing. We'll gain $12,000 if they expire worthless. This spread we're adding is net $48,000. So 12 of that we get back when those things expire worthless. And then we would obviously roll, or before that, we would roll the 35s to a lower strike. The 35s were 7 at the time, and the spread was a net of 240. So it's not a very expensive spread. We just wanted more protection into the weekend. We still want that protection into the Jackson Hole conference in case people are disappointed, and we're still going to want it into the Fed in case people are disappointed. So we're going to be basically sticking with that. That's one, by the way. So we've already added that hedge, and that hedge of 200 of the 35-45, that's a $200,000 spread that we added for $48,000. SQQ, nope, one more Q, is currently at 33.38. It's a 3 times ETF. So for it to get to 45, it would have to go up 12 bucks. So 12 divided by 33 is 36%. So therefore, it's a 3 times ETF. We need a 12% move in the S&P down, or in the NASDAQ, sorry, in the NASDAQ. So 12% down move in the NASDAQ would trigger that hedge to fully pay us $200,000. So now we look at NDX. So that's still a good hedge. It's cheaper now than it was then. So I think if you're going to add a hedge, that's one to add, and we've already added it. Now the question is, how much is a 12% move? That's going to be 7740 times 0.88, 6811. So basically back to this low, even lower than this. So we'd be looking for a correction as low as we were in June between now and January. So that's the breakdown we're looking for, and that would pay us in full $200,000. Although anything along the way will pay quite a lot of money also. We've already added that hedge, and that's still the one I would go for. So we're talking about the January, and you could possibly do better than that, but the January 35-45 spread is there. In the options opportunity portfolio, did we add anything here? We replaced them. Yes, and we did the same spread. It was also SQQ. In the options opportunity, we also did 100 of the January 35-45 bull call spreads. Now, the question is having another $150,000 of protection in the portfolio against a 10% drop in the market make us comfortable enough with our long-term portfolio positions? And I would have to say I'd like to do a little bit better. All right, so I think if we're going to add anything, SDS is at 30, DXD is at 27. So I think the move that I'd look for here, we already have the 25. So these are in the money, and these are in the money, or at the money, and these are not at the money. So I think if anything, I would want to roll these January 30s down. If we roll them to the 25s, they're going to be, that'll cost us about $2, maybe $2.40. If we roll the 30s to the 25s for $2.40, that's going to cost us $48,000, not peanuts, but we're going to put ourselves further in the money. So that's one possibility for like giving ourselves more legroom, more headroom. Obviously, if that 48,000 is in the money, it's going to pay double on anything going up. And if we roll it, but is that where we want to spend 48,000? We don't want to spend too much money. We have to think about what's going to be most efficient. It's more efficient for the January calls, but for the new, the new 35-45 spread is more efficient, but it's short term, whereas that's long term. So in other words, we're spending 48,000. If we spend the same $48,000 to buy more protection, the problem is that protection wears out in 4 months. And then where are we? Now, obviously, we're going to roll the long calls before they lose half their value. And hopefully then it wouldn't cost us the whole 48,000, but you can't count on that. When you spend 48,000, you got to imagine that it's been spent. So I think I'm most comfortable with I'm thinking about what I'm saying. I'm like, maybe I'm not. No, I think what I want to do is roll the short. All right. So what I want to do is I want to roll these SDS calls down. So what we're going to do is take this hedge that we have now, and if you want it as a new hedge, then it's fine. Notice these calls have gone up. These SDS calls have gone up. So they're more expensive than they were. That's a good thing. So the S&P hasn't quite blown us out like the NASDAQ. So we should do it with the S&P. So let's roll these down $5 to the 25 calls. That should That should cost us $250, and that's only going to be $25,000. And that will widen our spread by $5. So we're going to get $50,000 worth of additional protection doing that. But as a new spread, it's very advantageous because you're going to spend let's say 5 and plus 250 is 7, 8. Let's say you're going to spend $8 for these calls, for the 25 calls, and you're going to sell the $40 calls, SDS, that's a short on the S&P, and you're going to sell the $40 calls for $360. So that's net $440 on what becomes a $15 spread. So your upside is 200% at 40. And meanwhile, you're pushing your calls are going to be in the money by $5. So you're going to get every penny of every move up in SDS. So I think as a new spread, that's the way I'd want to go. We sold the January 37 calls. These are going to have to get, oh, I'm sorry, we sold the short calls. Oh, that's nice. Okay, well, I'm glad we did that. So we sold these short calls. They're going to expire, and then we're going to be able to sell some more calls. We collected $9,000 on those. If we can collect $9,000 every for the next 6 months, that's going to drop our cost from $25,000 to about $15,000. And that's really well worth it to buy another $50,000 worth of protection. So that's what we're going to do. That's going to add $35,000 of protection here. Plus, we already added the $150,000 worth of protection on the SQQ. So I think that'll be plenty for now. But again, we always have to check back and see if we're balanced and if we're doing it correctly. But those are the two I'd like to go with. And I'll write that up when we're done with the webinar, which will be very shortly, actually. So meanwhile, now that people have had a chance to digest the Fed minutes, where are we? So in other words, what we always want to do is when you get some money in the long-term portfolio, it's only it's unrealized gains. Those paper profits doesn't mean anything. But you want to take some of those unrealized profits and use it to add money to the short-term portfolio or add positions to the short-term portfolio. We don't need money, we got tons of money. You add positions to the short-term portfolio and increase the protection. That way you're locking in your gains effectively from the long-term portfolio. So even if the long-term portfolio goes down, the short-term portfolio goes up to make up the money. And that's the key. I mean, now, because we are obviously very, very, very bullish and highly correlated to the market, where basically we're making at least $50,000 to $75,000 per 1% gain in the S&P in the long-term portfolio. So God bless it, it can go up and up and up. And if you think about it, what if there's a 10% gain? We're going to gain almost the entire value of the short-term portfolio if the long-term portfolio, if the market goes up 10% from here. We're going to gain all that money. So even if the short-term portfolio got wiped out, we still have all the money that we gain. Now, obviously, we expect to do a little bit better than that. We don't expect it to be completely wiped out. But that's what we're looking at, is that the short-term portfolio is locking in the gains of the long-term portfolio. If the market has a huge rally, like a 1999 kind of thing, and blasts higher because of the China trade deal or whatever, we do the deal, we're still going to be in good shape because the long-term portfolio is capable of making more money than the entire short-term portfolio is worth. So even if all of our hedges were completely wiped out, we would still make quite a lot of money on the overall net. All right, and the same goes in the options opportunity portfolio, and that same thing on Thursday, I already added the hedge, and the options opportunity portfolio is pretty well balanced. In fact, right now, without that hedge being added, I don't think it was added at the time, we're up almost 200% in the long-term portfolio. So you're looking at, this was a $100,000 portfolio. It's almost $300,000 now. So it's not even 2 years. So it's hard to do much better, right? We're just doing really well, and all we want to do now is not blow it. At this point, if you're a good hedge fund manager, what you got to concentrate on at this part of the year is like, don't blow the $200,000 you made in 2 years. The 100% annual gain. So let's just not mess it up and we'll be very happy people. And that's where we are. So, see, anybody have a question? No questions. How good? Okay, good. So that's moving right along. I'm going to be on Money Talk in 2 weeks. We're not going to do it. Well, we'll do a webinar next week, but we're having the money. We're going to be. The problem with Money Talk is the hedges didn't. Well, the hedge got blown out because of TZA did a reverse split, so it ruined our whole hedge. And but that's okay. But also we had a couple of problems with our positions as well. But still, still up 126%, so it's not terrible. It's just, in fact, we started there with $50,000 back on September 6th. So it's just coming up on a 2-year anniversary now. And it's up 126,000. This is the one that we can't check, we can't change that one. Butterfly portfolio should be doing very well, up 100%. Yeah, because we got more bullish on positions that did very well. Disney's doing very well for us. Apple, of course, doing very well for us. Yeah, so, everything's fine. Honestly, I just worry about the rug being pulled out from under us. I really do. I mean, I don't feel comfortable having these kind of gains and still trying to make more money. I think it's just basically greedy. Oh, look, the market slipped a bit too. The problem, look, it's better to take some money off the table. And again, we're doing this to teach people how to trade. So it doesn't make a lot of sense just to go to cash and to say, okay, we're not going to trade anything for the next few months because I want to see, honestly, that's the thing people should do. I mean, you should really, at this point, if you're up anything like this kind of money, why not just take it off the table and relax? Take a vacation, enjoy your life. I mean, if you, especially, 100%. I know you want to make more, but you can always come back and make more. You can always take some time off, visit the family, see your family, see something in the world you haven't seen before, do something. Maya just came back from a whole summer vacation. And didn't miss anything. That's the thing. There's nothing really happened this summer. The S&P hasn't gone anywhere this summer. So Maya took the summer off, and where were we? Here's where we were in May, and here's where we are now. Yeah, you missed this, you missed that, missed that. But on the whole, everything's basically where it was. So you don't miss anything when you take some time off the market, and you certainly don't miss anything by taking, if you're up 100% of portfolio, I strongly advise cutting it down to half. And if you can't think of what position to take half of every position. Just take half off the table. Put the money on the side, and God forbid that, if the market's going to double again, you know what's going to happen? Instead of having 200%, you'll have 150%. Because your 50% will double, right? And you'll make, and so you'll have the money you took off the table, 50%, plus another 100%, you'll have 150%, instead of, if you left the 100% on the table, doubling at 200%, all right? But on the other hand, if the market drops and you would lose 50%, then instead of having 50%, you'll have 75% of your money. So you're, and 75% you can easily recover and get back to 100%. 50% getting back to 100%, that's hard. Not only is it hard, but it means that all the time you spend getting the 100% gain is wasted. And that's why I'll keep adding these hedges. It's annoying when you start losing money on the hedges and they go down or whatever, but it's a lot more annoying when you wipe out a year, 2 years worth of gains just because you didn't get out, just because you didn't see the signs to get out of the market. I think we're toppy. I think this is a very dangerous market to trade. And if I wasn't locking in and protecting everything with hedges, I would cash out. And again, I've said this before, my kids' college funds are in cash. Okay? If it's money that you need for a purpose, if it's money that you need to retire or to live your life or whatever, you shouldn't be playing. Now is not the time to be playing with it. Wait for the next good correction. Now, for my kids, the bottom line is this, the college funds, we're fully funding their college. Okay, they each one has like $250,000 or something in it. So it's enough money for them to go to any four-year school. The way the college funds are structured is any money left in the college fund is taxed at 50%, because it was tax-free while it was in there. It can be used for education, but anything that's not used at the end of their college, the government takes half. So there's really no point in making more money. I can gain, so in other words, all I'd be doing, it's not a win-win. It's like I can only win half of whatever I win. But if I lose, and the government doesn't bail me out, I have to then put money in to pay for college. So, I put money in, when they were born, like 15 years ago plus, and I put money in for the college funds, about $100,000 in each. Now there's $250,000 each in the funds. So I made 150%, or an average of 10% a year trading in their funds. Mostly ETFs are like shitty trading, but what can you do? Rode out the crisis. It was looking bad for a while. Back in 2008, those things were down. They were barely, I think they were probably less than what I put in the first place. And that's like 8 years into it. At the halfway point, we were down tremendously. Unfortunately, I got a lot more active and built things up. But it was very scary. For in 2008, I was very worried that we were not going to have enough money in the fund to pay for their college. And they made a nice rebound, of course. So the point is, though, that money, so that's money that's for a purpose that is important. It's my kids' money. It's not my money, really. It's their money. It's nothing I would gamble with. And so we cashed it. And you have to think about what you're really doing with the money that you have in your portfolios and how you've allocated your resources and so on and so forth. But if you had a really good run, the markets are really uncertain right now. You're heading into a time where the China thing could either go very far up. We could have a deal with China, but it doesn't seem like it, but it could happen. Or we could have no deal with China and it can definitively break down and the markets are going to tank. The Fed could either lower rates, but I doubt they can lower it enough to make the market happy, or they cannot lower rates and the market will crash because of that. You have a president who might be impeached and the market could crash because of that. There's so many things that can screw us up, and not that many things that are going to rocket us higher. So you really have to consider what you're doing with your portfolio money. It's a good time to lighten up. And I really strongly just advise thinking very hard about it. Hedges aren't magic. They're not going to save you from a very big correction. In 2008, a lot of people very complacent, thought their hedges were going to hold up. Even the hedges we have in our portfolio, they're only good for a 10% plus a 10 to 20% drop in the market. After that, we don't have hedges. We would add them if we have to, but you don't know that you're going to be able to add them fast enough. You don't know what else you're going to do. You don't know how much it's going to cost you to unwind your longs. We got a glimpse of that. The long-term portfolio was getting close to $1.2 million. Okay, 1.2 million is up 100%. I don't want to go below 1.2 million. I will cash the long-term portfolio rather than go below 100%. And as I said, right now it's up 140% basically. Right? I'm sorry, 170%. What? Oh no, because it's not 1.2 million. I'm sorry. So 1.2 million is up 140%. I'm sorry. So, right, 100 plus another 200,000 is 40% of 5, right? Yeah. No, wait. Double is a million, another 200, right, I'm sorry, 140%. So 30%. This last rally, the last dip that we just had in the S&P hit this portfolio for 30%. Wasn't that big of a drop. Because we have a lot of positions and they're pretty damn volatile. So this 3027 to 2822, a 200-point drop in the S&P, which is only like 7%. Okay, 7% drop hit the portfolio for 30%. I don't want to go below that. So we're adding hedges, and the hedges should protect us all the way to the 200-day moving average. And we expect that we'll get a bounce off the 200-day moving average. And we had a similar problem in June. But that's how low we're going to bounce. That's how low we could go. And we could go much lower, though. If this fails, the whole thing can start collapsing. And we can see this line. Look, this is an M pattern. Boom, boom. So far, you've escaped it. But it's possible that we break down and just keep going. All right, I don't think so, but it's hard to say. It's hard to say what's going to happen at this point. But look, look what does happen when you fail the 200-day moving average. That was just December. Okay, now we were lucky because we were very well hedged. And when the long-term portfolio got hit in December, we didn't have anywhere near as much money. We had an amazing year, but we had an amazing year because the market came down here. We had lightened up already in the fall. We had cut a lot of positions out of the long-term portfolio in the fall. We had a ton of cash when it crashed, and I called the bottom pretty much dead on arrival. Right here on December 26th, we started buying, and we got very aggressive. That's why we have such an intense amount of money now. But you got to protect it. And you can't just say, oh, I got hedges, blah, blah, blah. No, it's not enough. At some point, you've got to say, this is enough money, and I'm going to cut, and I'm going to get back to cash. And we're going to start more or less fresh. Now, I say that, I always want to do it, and I love the positions we have. We have a lot of great positions, but you can also just cut back on the amount of exposure you have in each of your positions and start taking cash off the table. And then next year, if we're still up and everything's still going strong, you can buy some more stuff. But it's really hard. I mean, if we're going to go all the way back down to here, and this portfolio goes from 1.3 million back to 750,000 or something like that, that's crazy. That would be an insane amount of money to give up. And I don't want to do that. And I don't want people to get the idea that just having these hedges in the short-term portfolio is going to stop that from happening. It's not. These are leveraged positions with a lot of exposure right now because they've been so successful. We have huge positions. They're hard to protect. So we can't be complacent about this stuff. I'm willing to go down to 1.2 million, but 1.2 million, I'm out in this portfolio. Now, if we're 1.2 million in this portfolio and we have 800,000 in the short-term portfolio, that's $2 million up from 600,000 in 2 years, 1.4 million gain. But the combined two portfolios are up from 600,000 to is 200 and something percent, 230% total gain in the two portfolios. That's fine. So I'm willing to gamble from where we are now, 2.3 million, to end up at 2.2 million. I'm willing to gamble about 15% of what we have on the chance that we can go up another 50%. But it's almost not worth it. It's almost, again, bird in the hand, two in the bush, right? It's 15% in the hand that I'm not going to lose. If we quit now, I keep the 15%, and all we're trying to do is get up 50%. That's two in the bush. Two in the bush would be 30%. So it's a little bit better than two in the bush, but it's getting close to the point where it's not even worth going for. So I'm telling you now, there's an extremely strong chance that we're going to be very much more cashy into the winter. In fact, I can't see keeping this up through Thanksgiving. The election year next year is going to be crazy, and I don't want this kind of exposure. So, you know, we'll see what happens if again, the positives I can see is the Fed can lower rates a 0.5 point, and that'll boost the market. And then we can make a deal with China, and that'll boost the market. But once that happens, I'm cashing out. So if things go really well, I'm going to cash out, or if things go poorly, I'm going to cash out. But if we don't break out of this range here, the 50-day moving average, and the S&P right now is at 29.22. So where was that looking? Oh, on this chart. So 29.22, 29.46 is a 50-day moving average. We can't get over that line. And we're having problems getting over here. We're very likely to come back down to there. And do you want to be on this roller coaster? All right, everybody's got to consider that very carefully, and don't look at hedging as the answer to everything. Cash is the answer to everything. Okay, we can always find more to trade. In fact, I'm doing this thing now. Oh, I forgot about that. Damn it. All right, anybody got questions? People do have questions. Todd says, does that hold for retail positions? And I want to say no, but I'm just saying, if the market goes down, everyone's going down. So we got to consider where we're going to be very, very carefully. FTR has been rising the last few days. Any idea why? No, actually, we haven't even looked at FTR. I decided not to look at them. And see that it's like a watch pot never boils, right? Because I don't know what actually happened, because I decided that looking at FTR was just too annoying. Oh, look at that, 82 cents, all right. Well, we bought a lot. Don't forget that we bought a lot. So we might have caused this excitement here that got people buying, because they may have seen us buying, because we had it at the bottom. And to some extent, we may have caused some of the move up, but I'll check and see if there's news in chat, so remind me. But anyway, yesterday I started doing one of five. I did 2 of 5, and I think I mentioned. Hang on. Seriously? Oh, I see. Trades. What? All right. I write it, you know, seeking out friend the Maven. I do some writing, and I decided to do something fun for people. So we're doing 5 trades that are going to make each $5,000 in 5 months by January. So I'm looking for things that are going to pop up. So I like the play that was going on Apollo. You can see the stuff in the member chat from yesterday, 10:30 we started. And I like Marriott Vacations, which popped nicely. Wow. Holy cow, it really finished today strong, didn't it? Again, it's hard to say, because like it's possible because I wrote that up, it went like that, because that's crazy how it took off. But like I said, I thought the news that there was a merger, there was this Hilton Grand Vacations is being bid on by Apollo, and at 36, and they were at 26 yesterday or whatever, and now they popped up to like 32. So I said, you know what, I've had my eye on Marriott Vacations for a long time, and I wanted them. I was hoping they would break lower, but they broke, you know, they came back up to here, and we decided to start getting in. So our position is to go, and again, very conservative. I just think they're going to hold 90. So the position I took was to say, why don't we sell 5 of the 85 puts in April and buy 7 of the 80-90 calls? And that gives us a net entry of 1525, and it pays 7,000 if it all works out, which is 5475. Now the short puts don't expire until April, but they'll lose a good, it'll come in nicely. It'll put a good amount of money in our pocket. It's a good little trade. And like I said earlier, the other trade we were talking about for the hemp Boca portfolio, which is right on the main page. Whoop. That's weird. Oh, I see, because I'm not the author. Somebody else put it up. I think Greg put it up for me. So in the hemp Boca portfolio, we did it with THC, and that hasn't moved much since, so that's good. We were looking at THC before. So THC, same kind of thing, $18 puts, 5 of them, but here we're doing all Januaries. Why does it say 2021? It's not supposed to. It's supposed to say 2020. Shit. Wow. I messed up. All right, well, I'll fix that. It's going to be on the, it's up on the main page. So the idea is, and again, it's a $2,000 cost, it's a $7,000 spread, and it should make, no, wait, I said 16 months. Oh, I see. Okay, I'm sorry. I apologize. This is not one of those 5. I'm gonna make it one of those kind of trades, but I haven't done the numbers yet for Tenet Healthcare. But Tenet Healthcare is another one that we're going to do the same kind of thing. In the hemp Boca portfolio, it's going to make 5. It's just coincidental. I got mixed up in my head. We're going to make 5,000. This is a 2,000 spread that's going to pay back 7. It's a great trade, but it's not going to take 5 months. It's going to take 16 months to make that money. But all it has to do is hold 20. A very conservative way to play. We're just playing Tenet Healthcare to hold 20. So keep a lookout for that, and I'm going to be having 5 of those articles. There's going to be 5 trades total, and the idea is to make 25,000. And basically, each one is going to be a $5,000 spread between them, between now and January. But the point being that we can do this anytime that we want to. We can always find things to play and go forward. So there's nothing wrong with having cash. Okay, we can always make new trades and come up with different ways to make money. You don't have to make money on the positions you're in now. You don't have to make money with the portfolio you have now. We can always find another trade. There's always going to be something to play. All right, so that's where I'm going to leave this webinar ended. Just consider what you're risking. And, this is a crazy, crazy environment. And if you made a lot of money, try to enjoy yourself. Do something nice with it. Other than just keep, you can always come back and trade, but you don't need to sit there all the time. This rally has very, very likely run its course, and we're going to have a correction, and the correction can last weeks, it could last months, who knows? But I just the way policies are going and the way that, and when you see things like 500,000 jobs that were added were fake and things like that, that's a problem. That makes me very, very worried about investments going forward. So we'll see what the repercussions are. And we won't know much until a month from now is that Fed meeting. So we're not going to have a really good answer for a while, unfortunately. All right, so everybody be very careful and think about what I said, okay? Have a good day. We'll do it, and we'll do this again next week.